Hello, everyone, and welcome to week one of financial management for nonprofit organizations. So let's begin with the most basic question. What exactly is a nonprofit corporation? How do we know that it's a nonprofit? The term nonprofit is actually just an IRS tax determination. It is a legal term for a certain kind of corporation. And it means that these certain corporations do not have to pay taxes. They are tax exempt. And it also means that people who donate money to these certain tax-exempt corporations may take a tax deduction for the amount of their contribution. Now, the IRS has several important standards for what will make an organization a nonprofit, a tax-exempt organization. And one of these standards is that the organization must have been created, organized, and it must operate exclusively for one or more purposes that the IRS has determined are tax-exempt purposes, and these are charitable purposes or religious, educational, scientific, literary, and a host of small odd ones such as testing for public safety, fostering amateur sports competition, prevention of cruelty to children or animals, etc. Now, this tax-exempt status is in fact a federal statement, but most states also use the same tax exemption, and therefore the organization is exempt from state income taxes, paying sales taxes, paying personal or real property taxes. But this is not automatic, and it's determined on a state-by-state basis. In addition to its purpose, the other important standard is that the organization may not have been created, and in particular may not operate to the benefit of private interests, individuals, or groups. No part of this 501c3, in this case organization's earnings, may go to any private shareholder or individual. In fact, any earnings and any surplus that a nonprofit organization generates must go back to the mission of the organization. Now, in addition, certain categories of nonprofits, the most common being called the 501c3, are also prohibited from any lobbying or political activities. So, the Internal Revenue Service has created, obviously, a number of different categories of nonprofits, and being the IRS, they each have their own code. Among the most common is the 501c3, the charitable organization that may not lobby and where donors can take a tax deduction for their contribution. And the 501c4, still a tax-exempt institution, but it may conduct lobbying and political activities, but its donors cannot take their contributions as a tax deduction. So let's look at a few standard differences between the nonprofit corporation and a for-profit corporation, and we're going to look at them by purpose, ownership, how decisions are made, and what happens to the surplus. So the purpose of a nonprofit the purpose of the nonprofit corporation is ostensibly to accomplish some goal or goals that will improve society, while the purpose of a for-profit corporation is to make money for the owner or the shareholders. Interestingly, nobody owns a nonprofit, not the management, not the board. Its assets, should it dissolve, will have a lot of legal restrictions on what happens to the assets, but nobody owns it. While a for-profit corporation is owned either by an owner and or by shareholders. Nonprofit corporations should be making their decisions mostly on how that decision aligns with their mission and with their values, and will this decision further or detract from its mission. While for-profit corporations very simply make a decision based on, is this going to increase our profitability or not? None of which is to say that the nonprofit corporation should not also be thinking about how a decision will affect its financial health, or that the for-profit corporation cannot also take into account decisions that will affect some of its own values, such as environmental results or some sort of social impact. And finally, in a nonprofit, surplus must be invested back into the organization. It can use them to increase its reserves, it can create new programs, but it must go back to the organization. While in a for-profit corporation, a surplus may go back into running the for-profit, but it can benefit the owners and or the shareholders. Now, just because a corporation is a nonprofit, that does not mean it can ignore its fiscal health and stability. It has to be watching that as well as what good it can do. And just because a nonprofit is staying fiscally healthy, that doesn't mean that it's accomplishing its mission. The point of the nonprofit is not to just continue itself. It's to accomplish certain missions that will benefit the society at large. So the nonprofit and you as a nonprofit leader has to make decisions, almost two decisions simultaneously whenever making a decision. One is to ask, how will this decision impact, or how is it relevant to our mission? Is this decision doing what will help us reach our mission? Is it relevant to our mission? But at the same time, the decision has to ask, how will this impact on the fiscal health of our organization? It does no good to do a whole lot of good while running the organization into the ground. A bankrupt nonprofit leaves a huge wake of pain and distrust behind it. So as you make your decisions, realize you are always making two decisions simultaneously.